Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts and Samir Khalra of Target Investing and Vinita Sharma of Narnolia Financial Advisors join me on the show. Many thanks to both of my guests for joining me. Today on Hot Money, we analyze the gold financing companies. Both of them came out with strong set of numbers, Manappuram and Muthoot. We asked the guest whether the rally will continue for Balkrishna Industries. The stock did manage to rally over 10% post a strong set of numbers that came in yesterday on Friday after market hours. We asked our guest whether the weakness will continue in the generic pharma sector, and NCC is down another 10% today, so there is serious issues as far as the stock price is concerned. We'll try to find out what exactly is plaguing that stock. But let's first start with the first one, gold financing companies. Yesterday, Muthoot Finance was up 17%. Manappuram was the other one which was up almost 4 to 5% in trade. But what's the view on these stocks going ahead? How do you analyze the numbers here, and what's the way ahead? We'll ask our experts here. So Samir, I'll start with you. Yeah. Now both the numbers came out. Yeah. Muthoot obviously rallied significantly and Manappuram had come out way earlier. Yeah. What's your outlook? How do you analyze these numbers? And what's the way ahead for someone who wants to invest in gold financing companies?
So I think someone who wants to start right now should do a SIP approach. There's two instances, because what is happening, first of all, the gold prices itself have ramped up. So there are a lot of people who are not able to get the conventional loans are coming for gold loans, whether it's MSME, personal loans or individuals. So the gold loan growth is going up in the volume wise also. Secondly, this cash flow which they are getting, because this is a shorter term loans, these revolve much more quickly than other. They are pushing that liquidity, these companies are pushing that liquidity into gaining market shares into non-gold, which was the main criteria to diversify the books, which they have been trying to do for past at least 3-4 years, but now it's picked up a good amount of speed. So they are able to diversify into these long-term loans with the cheaper cost as well, because your liquidity is, your cost of borrowing is lower as compared to let's say a same rival in the company. So let's say a Shriram Transport does a more expensive loan as compared to a Muthoot on the company basis. So the more the market share they gain, the better valuations they'll attain, and they'll shift from these conventional gold companies being called to a non-gold and a diversified. But then again comes a risk that the gold prices, if it tips off, though I don't see anything happening in the next 6 to 9 months, if that tips off, then the reverse will start happening. So the prices will go down, the LTV, the amount of gold which they have will start to go up. So there will be a reverse. So the risk is the gold prices, which is external to these companies. That's the biggest risk from my point of view. And the second is the delinquencies in the gold books right now are very less, because they are shorter term loans, so it doesn't involve that much. But when they go into more non-gold, the delinquencies, how they handle the asset quality over there, that becomes the criteria. So I think right now it's a prime time for them. So keep a SIP out here. Don't do a lump sum and expect a one-way journey from here on, at least from my point.
Which is a better bet if someone wants to take a bet among the two of them? Which is a better financially managed or operated company between both of them?
So I think, according to me, Muthoot looks much better in terms of how they are trying to expand the portfolio as well, and the costs they are giving out in. So I think over there, Manappuram is a little, let's say, more aggressive in terms of lending and the cost cutting. So that's where I think Muthoot gets an edge over there, and that's where I feel much more comfortable.
Muthoot is a better bet on Manappuram. What's your sense on gold financings? Do you all have coverage on these companies, and what's your outlook?
So I think we are liking both the companies, and you asked which one one should take right now. So it's about your portfolio, because Manappuram and Muthoot have a basic difference, that Muthoot has primarily gold loans and Manappuram is little more diversified. It has MFI portfolio also and other loans also into CVs. So what kind of NBFC you are already holding in your books will depend as to which company would you like to buy. As of now, on a price to book ROE scenario, both the companies look good. What concerns right now is, the gold loan, I think should go on, and the growth, this is highest of one of the growths that we are seeing. Maybe the growth little bit tapers, but I think there is a future for the gold loan going ahead. What concerns is right now, most of these companies, they were not getting bank loan. So, and getting a bank loan, and so the yield right now is already at for these companies are 24 odd percent, and the NIM comes out to be 16 to 18%, and they have now been able to raise loans from ECB. So that's a good point that they have they are able to raise loans from ECB, which is a low cost fund. But then going ahead, it will have its own foreign exchange hedging, and that sort of thing will continue for both these companies. So maybe on the cost front we need to analyze it a bit more. But going on the asset base, I feel there is good amount of growth. Also, valuation upside seems to be there.
Seems to be there. So, what kind of strategy, SIP type, or would you be aggressive in buying either of these companies at this point of time?
See, already once the valuation looks good, so it is most of the company, both the companies in fact are running below 2.5 or around 2.5 times price to book for FY20. So, person can outrightly take a bet on these companies. I don't think it's too essential to have a SIP approach.
Okay, that's the view that's coming in on the gold financing company. The second stock we want to talk about is Balkrishna Industries. Now, remember, trading at record highs. Yesterday it was up 10%. I don't know what the counter has done today. Pull up the counter to see the performance, what it's done today, but it's down 2.5%. But nevertheless, came out with extremely strong operational numbers. The management commentary also indicating that issues in China will help them, better weather conditions, better expansion in Europe market, all of them aiding to the growth probably that will come in. But overall, we've seen most of the tire companies, except for probably TVS Sri Chakra, come out with very strong set of numbers. But Balkrishna is trading at record highs. Do you like this stock? What's your view on the counter?
Yeah, Balkrishna is a good stock. I think we can have this as a buy. And earlier we were little neutral on this stock, and we were not aggressively asking people to buy this. But because we were not very sure on how the volume numbers will pan out. So two things Balkrishna has done. One is that they are giving good guidance going ahead. Already the tractor division, I mean 60% is into agri. The portfolio is 60% into agri. And in Europe, things are turning out. So what the management, they guided that maybe the weather conditions will will help for FY21. So one is the volume growth that we will be seeing in Balkrishna, and second, the margin expansion. So they have done a backward integration for carbon black, and already that is started. So another round of carbon black expansion is pending going forward. So on the margin front, already we have seen a 400 sort of a basis point run on the gross margin. And whenever we see any tire company, if you look at it, the gross margin expansion is very important, because in the last cycle also, all the gross margin expansion normally translate into EBITDA improvement. And since on the other side, below EBITDA, the interest cost, etc., that is very much controlled for Balkrishna. They don't have too much of debt. Also, the expansion plan that they were planning for US, that is that they have pulled, that they have put on to hold. So 700 crore they save right now, so they're not taking any kind of a debt. So that gives a leverage for Balkrishna to expand the net profit margins, where C8 is running at a 2.5 to 3% net profit margin. This company gives you a 16% net profit margin. Valuations, of course, once the balance sheet and PL is that way, that will be a little higher. But on a PE basis, you'll find it a little higher. But on a net worth price to book basis, it is okay, around 4, but then it comes with a ROE of 24. So I think fairly justified. In the auto components, anyways, we are not getting any company right now on which we can really count on, because because of the auto scenario. So I think Balkrishna, amongst the tire companies, can be a good bet to buy.
Okay. What's your sense on Balkrishna? What did you make of the numbers in outlook?
So I think numbers were decent enough, and even if you see as compared to the whole universe of tire stocks, that's a preference bet because of the balance sheet and control of working capital. Now working capital is getting a little stretched in terms of the payments getting delayed a bit or the other. So distributors are also holding off to a certain extent, and especially if you see the lower base of volume last year has helped the 1% volume growth which they have shown this year. So that really doesn't excite me when I'm going for high growth at these kind of valuations as well. So it can sustain because of the the raw material costs which are out of your control, and you can give that extra PE to them. But the only problem with me is till the time the volume pickup doesn't happen. So do remember this was December ending. So a lot of distributors have year-end closing impact as well. So I would still like to see a March quarter how it works, and especially when people are saying India can replace the let's say the China issue globally. Right, it doesn't happen overnight. There's a lot of issues, there are a lot of pickup, and globally also activities have dropped up drastically, whether it's private capex, infra spend. So OTR is their main forte of tires, and Titan is the main competitor for them. So I think Titan has reduced certain prices also, and the capacity expansion which they've put on hold, from my point of view, that's a little negative for me. Because at that moment, if you were already working and China issue can sustain for next 2 to 3 years, or there's a kind of a competitiveness already versus a Titan. So I think you could have done better over there. So I'll still hold a neutral to a still another 15 to 20% downside, then I can.
Is it only that when auto as a sector has slowed down, auto as a sector has slowed down, was it only because of the raw material benefit that they had, that these tire companies were able to show good results, and probably the top line most of them degrew from most of them. Is it still a concern?
Yeah, it's a major concern because see, if you see a lot of tire stocks, they throughout the years they have been on a continuous capex cycle. So wherever no one puts a capex, they lose the market share at that time only, and the pricing power also removes off. So they have to keep on doing continuous capex to maintain that. In India, the problem is the OEM sector is facing a lot of issues on pricing. And aftermarket, again, there's a longer purchase cycle than what it earlier was. So there's a system change. I don't think so it's going to be into a very plus any which way tire stocks except Balkrishna we never liked. So I still stay away from tire stocks.
What's your best pick in the tire space? If someone has to pay the tire space?
As in, I play through exports only through Balkrishna. We don't invest through any other tire stocks. Even MRF to a certain extent was there, but I think the valuations are surpassing at every level.
What's your preference? You said you like Balkrishna, and among your clients, which is a preference for the tire stocks?
So we analyze some of the tire stocks behind, and then I think we are still liking CEAT in that sense. The net profit margin, as I said, has gone down to around 2.5–3%, and that is primarily because of the debt that they have in the books, and they have a good amount of capex going forward. But if you look at 2–3 things, one is that on the specialty tire business they are investing into a lot, and I think that should help in taking the gross margins higher going forward. Also, the replacement market that CEAT is into. So, last 2–3 years, pre-18, we have seen good growth in the auto two-wheelers, and so I think going forward, the replacement market for CEAT should be good. So that's the reason we are liking CEAT as of now.
Okay, that's the view that's coming in on the tire space. The next sector is basically the generic pharma space, where we've seen a rally come out in some of the diagnostic stocks and some of the API manufacturers like DVs, or probably even some of the hospital stocks like Narayana Hrudayalaya or Apollo Hospital. One main sector which hasn't actually done well and is seeing a lot of pressure is the generic pharma space. So basically you've seen counters like Sun Pharma, Lupin or Aurobindo. Dr. Reddy has probably been a little outperformer, or even the large ones like Sun Pharma come off in trade. So what seems to be the concern in this generic space? Is it a right time to take entry into this space? That's something that we'll ask Samir. Your sense on this generic pharma space, anything you like? What seems to be the problem that generic pharma companies are facing?
See, the problem mainly what we see is US prices are still flat. They came up in month of November, December slightly, but again in January and Feb, as of now, they have reduced to a certain extent. So again, they are flattish. So generic prices are not moving up in a one-way stream. So that's why even if you see the numbers are good on the face of it, but if you see it on quarterly basis, they are still a little on a degrowth end. So for me, I think the main crux will be how they are maintaining these balance sheets through these issues, because pricing power in this system will not come anytime soon, because again you have US elections and this will become another agenda for sure. And again, if you see locally also, we have kind of capping back again and we are expanding the list under the NPPA. So I think these kind of issues for generic, especially when the competition is so high and market shares of even a 5 bips or 10 bips really pushes your numbers into profitability and cash flow issue. So focus on balance sheets. If you focus over there, then I think Dr. Reddy, Sun Pharma and Lupin are the places where you can keep a look at and how they spend on the R&D, because Sun Pharma is still picking up on the specialty. It has not come to a substantial area of revenue, but yeah, they are on the stream of it. So I would look over there. Lupin is deleveraging the books. Dr. Reddy has acquired Wockhardt and deleveraging its books at the same time. So these three are the main place. Other than that are just more of trading bounces.
What about the domestic space where someone like Alchem, who's basically focused more on Cipla too has a large domestic base. Would that be a preferred choice if the export side is facing issues?
But Dashan, if you see the IPM growth, that has also faltered to from those highs of let's say 15% plus consistently to a 10 to 12% or below a single digit now. So that is also coming off, because again, if your pricing is not there in the system, then whatever the 10% IPM growth you're seeing, at least 6 to 7% is the volume growth. Earlier it used to be at least 10% price growth and 6% volume growth. So that is not coming. So that ratio has to return for these companies to sustain these valuations. So that's where I see a working capital issue coming in a lot of companies.
What's your sense on the generic pharma space? Anything that you've told your clients? Do you see this pressure continuing?
So two parts. One where US contributes some 70 odd percentage to the sales, and the other is where India and rest of the world have a major portion in the revenues. So going by what Sun Pharma or Lupin or a Dr. Reddy, still I'm not very positive on what kind of growth will come going forward, though there has been a little change in the PL and the balance sheet of the companies. Sun Pharma, as you said, as Samir said, that it's going on for more of specialty chemicals, specialty pharma, and then that should contribute to growth going ahead. But that still cannot be seen. US regulations are still tighter, so plants for many of these companies are still not US FDA cleared. So still they are struggling with all those issues. On the contrary, those companies which are more on India or rest of the world focused companies, I can see some kind of a growth coming into, especially this quarter. If you see from last 2 quarters, they have been registering quite good growth. So there are two things that have been happening. One is the normal growth that is coming out of these companies on account of product launches, etc. Plus the share that they are increasing in the US. So some of the US share for all these companies is definitely shifting to some, so a very small share, but then that is important from a revenue point of view. That percentage, is important. So some 20 to 25% kind of a sales growth is being registered by Ipca or Shilpa Medicare, Ajanta Pharma, or even Alchem or EPL Limited. So 17 to 20, 25 kind of a range top line growth these companies are registering. And amongst the space, we are liking EPL Limited because
which one?
EPL Limited, Alembic Pharma.
Alembic Pharma.
That's because Alembic Pharma is one, they have a very, very good distribution network. So on account of, for last 2 years, we were seeing some kind of a degrowth that should have happened for Alembic, but then it turned out to be growth because of the certain opportunity that they took, and they are very, very smart in, you know, in their supply chain management, and they had this kind of a growth. Secondly, the opportunity that we think lies is, one is the China market. So pre-2018, they were totally, you know, the China was totally closed, and they were not encouraging other, you know, Indian companies to come and have a tie-up with them, etc. But they had some vaccine problem, and post that China has opened up for kind of you know, tie-up with other companies. And you must have noticed that Dr. Reddy, even APL Limited, they are coming up with tie-ups with China, and China is, after US, China is the next biggest market for pharma. So that, you know, that gives us a huge room of opportunities for pharma companies going forward. And APL Limited, that is Alembic, that is already some 2 years back, they have already had a tie-up, and Allure Derma, that kind of a company, and they have already channelized, some of the products have been given on approval. So we see good growth going forward and huge opportunity for pharma sector as of now. Certainly this coronavirus issue, the API, we get 60% of raw material, the APIs, again the intermediaries also depends on China. So that remains a short-term concern for all of us. But going forward, I think we can see some domestic, you know, domestic oriented or rest of the world oriented companies, because price to book ROE have now, there is a differential, and you will find good companies there.
Okay, that's the view that's coming in on the generic pharma companies. And the last one is NCC, or Nagarjuna Construction Limited. It has corrected significantly. It's down 8 to 9% today, if I'm not wrong. There is enough selling, so we'll pull up the stock and see what exactly it's doing. It's down 8%. Again, sub the 40 level. It was trading, I believe, close to 100 a while back. So there is some bit of pressure that's coming in on NCC. What's causing this trouble? Are you aware of what's gone wrong for NCC?
So NCC, see, we are not tracking NCC on a regular basis, but whatever I could understand is that they earlier had around 35,000 crore of order book, and because of the AP government cancelling a lot of order, now the order book already, so they have trimmed the order book by 13,000 odd crores. The order book, the visibility is some 8 to 9,000 crore top line growth visibility, top line visibility is there for the next year. See, but you know, a company which is going through all these turbulence, I think it's better, you know, we have never recommended NCC, it was never, so I'm not tracking this, but I think it's a better avoid, because in the infrastructure space, we have good companies. Certainly, you know, the new order books are not coming, but there are companies which huge order books, which gives you 2 years execution, you know, visibility. Say, for instance, PNC Infra. So it's more concentrated on the UP and north side, and some 10,000 plus kind of order book is there. Already for the last 6 quarters, it is giving a growth of top line growth of around 50% plus. It's been, you know, outperforming in the sense of timelines for its projects. So there are some equity requirements going forward, but I think the company's cash flow right now is, or the profits are enough to have those equity requirements fulfilled. So I think in the infrastructure bets, there are a couple of companies. PNC Infra could be one bet people can take.
Okay, that's the view that's coming in. What's your sense on NCC or anything? Firstly, NCC, let's talk about that.
I think NCC first, as she said, the order book is reduced. Right now, when your AP was highly concentrated, then again to recover that kind of amount of order book, you really need to either sacrifice on the margin, because you need revenue visibility and cash flow generation as well to, you know, sufficiently be able to sustain those debt levels. Now the execution also has reduced. The receivables have expanded. So I think working capital issues are here to stay for this company, and they'll increase quarter on quarter. So I think it's better to even exit at these levels rather than looking for an upturn. And in infra, you really need to be specific on what expertise that company has. If they're majorly in roads, I don't think so. Roads infra story will be a great story this year or next year.
Or what in the infra space do you like? Have you recommended any of the infra stocks?
So I think metros, so J Kumar Infra is there, so that's mainly dominated on the metro and highways. So that can flyovers, that's a major sector. Then PNC Infra, as she said. But PNC Infra, again, airport expertise are there for them. But what is happening, a lot of infra projects are now going to private players. So I rather play it through, let's say, a Siemens story where, it's a more of a proxy play rather than going for a particular company playing out, because L&T is also losing out a lot of infra projects to foreign developers. So I rather stay away from this space and pick out.
Okay, that's the view that's coming in on Nagarjuna Construction Company. But with that, it's a wrap on today's edition of Hot Money. Samir and Vinita, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.